Welcome back to In Your Money. We're discussing investments. My guests, David Shapiro and Craig Pfeiffer. If you'd like to email me, you can send your query to info@anchorcapital.co.za. And then, Craig, a question for you. People have asked this question. Please explain the difference between government retail bonds, which has guarantees, versus buying a government bond.
Probably the biggest difference is the one is really more institutional. The government bonds that they issue, they sell off to the institutions, and the value of those bonds fluctuates as interest rates go up and down. They are long-term bonds, 20, 30, 40-year bonds. That's how long they last for before they mature. So that's really more for the institutional market, the sovereign bonds that they issue. I think on the retail savings bonds is more for local individuals to buy, and it's more akin to kind of a deposit at a bank. Your value is not going to fluctuate as yields go up and down. You can get a good interest rate. I think there's 2 years, 3 years, and 5 years fixed terms. And I think the last time I looked, it was around 9.25%, 9.75%, and 10.75%. So that's your fixed interest rate for those terms, and the value of your capital is not going to fluctuate. But it's government, so it's also, as you said, it's guaranteed.
Would you put your mother's money in government retail bond?
Absolutely. I mean, it's horses for courses as well. So you must appreciate that the only return you're going to get is that interest rate. So you're not going to get any other capital growth or anything that you do from equities over the longer term. But if that's all that you want, and if you want a safe, you want your capital to be secure, and you want to earn 10% or whatever it is for 5 years,
yeah, and particularly
without risk.
Particularly if you're not in a tax situation, 10%. And I mean, interest rates are going to come down, because you started off by saying you thought the last time we looked it's 10.75. It's now 10. Which is an indication that that interest rate, long-term rates are definitely coming down. Yeah. Anyway, we're going to go to email. Paige in Somerset West. How do you go about choosing a share? What components do you look at, David? You're the one that takes the balance sheet, and dissects it, and then takes out the parts.
Yeah, it's very hard to give it in a sound bite, but I think I always look for. I'm theme driven. And to give you an idea, what's a theme at the moment would be AI. It's making the headlines all the time. So you look for businesses. If that's what's occupying investors' minds and economies' minds, then I look for businesses within those areas. But I always look for business. I'm saying each person's got their own way of looking for businesses, but I like businesses that have got strong balance sheets. That's an easy word to say. But what that means is that the assets are significantly higher than their liabilities. They're not indebted. They're generating profits, enough profit so that they can keep some back to reinvest in the company, pay dividends, and so on. In other words, that they're generating enough money to maintain the business that they do and keep growing it. So I'm trying to put that into very simple terms. To me, that would be a quality company. But themes can change. And it doesn't mean that once you buy a company, you've got to stay there life. Constantly look to see if whatever the reasons you bought it are still intact. I look at that every day. Are the reasons that I bought the share still relevant? If so, yes, keep holding it.
Craig, a company that pays dividends is really saying we're rewarding our shareholders, but we don't really have much extra to do with that money. That's why we pay higher dividends. Or is that an unfair statement?
I suppose it depends. Some shareholders want a dividend, and that's why maybe dividend yields have typically been 2, 3, 4, 5%. When those dividend yields start getting a lot higher, then you start thinking, well, can't they do something else with this capital? A big thing in the US is share buybacks. As part of returns to shareholders, they'll give you a little dividend, but they'll go and buy back shares. It means there's less shares in the market, so the intrinsic value of what you own has gone up, because the company's still the same size, but there's just fewer shares. So they try and return capital to shareholders in that way as well. So,
and aren't they also saying, we think our share price is undervalued in terms of the actual asset value of the company, and therefore we think it's better to buy some of the shares back, David?
That's a good point. They're investing in their own company, believing they're going to get better returns from their own company than by giving you the money that you could get. You know, it's around that. It's a point where there's a lot of discussion of what you should do with money. And you made a very valid point. If a company is now paying high dividends, it means that it's starting to run out of ideas. You must always consider that. You know, where businesses, why are they giving back so much? Haven't they got anywhere to go? Aren't they, you know, are they running out of ideas? Isn't there more runway for them to run, you know, to drive on, whatever it is? So it's so hard to give. You know, one's got to consider all of these factors.
And that would say also old generation companies, solid companies, pay dividends regularly. You know, but the shares don't go. The shares don't give you that go excitement over a period of time.
Yeah,
Joe in
we
Parktown,
go people.
Yeah, this is definitely for you, David. Joe in Parktown says, "I know you're a trustee of some retirement funds or pension funds. As a trustee with little investment knowledge, what should I expect from our investment advisors in order to make an informed decision?" You know, half the trustees are elected, and half of them are the company puts forward their names. So often the elected trustees who have the same responsibility and liability of decision making, but know nothing about investments.
That's bad. You know, I think the same applies in company law. You know, we always distinguish between non-executives, or sorry, you know, executives and non-executives. Yeah. The Companies Act doesn't distinguish. It says a director has the same duties and responsibilities regardless. If you're a director, you have the same responsibilities as a full-time executive director. So it's your duty to understand about investment. That's why you're appointed there. So you bring up a very, very valid point that, you know, where there are elected people and that, you must make sure that they understand what their duties are, which is to make sure that the funds are looked after to pay you your pension or whatever returns you want out of that.
And then if you're feeling out of your depth, then don't be a trustee.
Absolutely.
Resign.
Right.
You know, because really it's not a paying position. You may feel that it's an honorary position that your staff members have appointed you.
If you're going there for the tea and biscuits, no, don't do it. Yeah.
Okay. Craig Walton George says, do you think the dollar can continue to strengthen, and what will the impact of the stronger dollar have on US exports?
I think the general thinking at the moment is that the dollar will weaken, where investors globally will see better ideas in the market, will invest more into equities, and you know, as the economy improves in time, and in that respect, we'll move out of that safe haven of the dollar, and that will see it weaken, and we'll actually go out into other investments. If things start looking a bit pear-shaped again, or interest rates aren't coming down, then we might see the dollar strengthen up a bit again. But yeah, it wouldn't be good for exports. I mean, you'd earn less as a country. But I think, you know, at the moment we're looking at 106 to 109. We've been in a narrow range for some time, and I wouldn't see too much difference ultimately in that level.
But if the dollar weakens, then Dave, is this a time to take money out?
Yeah, that's always, you know.
You take it out.
I take it out. I'm driven more by opportunity. Where do I want to put my money? Which companies do I want to put in? Because, Bryan, if you look at even those companies you put up on the list there, you know, on the board, and you look at all the tech companies, no company only looks at its own country, you know, or operates only in the country. They're international. So businesses globally are operating, you know, in many different jurisdictions. They've got treasuries. The problem is that sometimes European companies don't have the same rating as American companies, because Europeans by nature are not equity driven. You know, they're much more socialistically inclined. Government will look after us, put their money in bonds. But so, you know, from that point of view, I don't think it makes much of a difference. I look at the long-term possibilities of where the businesses are going.
And if you take money and you don't want to invest it in the market, doesn't it make sense just to stay in South Africa, earn a bit of interest, which will give you your hedge against currency, Craig?
Well, it depends on your view on the currency. Even if you're getting naught in dollars and the rand appreciates by 5% a year, you're still earning something in rand terms effectively. So I wouldn't see it as too much of an opportunity cost if you want to send your dollars now and then just have a look, see, where you want to do. I don't think it's ever wasted, particularly if you've got a longer term view that the currency is going to depreciate.
Yeah, we never get it right. I don't think anybody ever gets it right.
The banks employ the top currency specialists in the world because this is daily news. Do I cash in my dollars that I've received? Do I pay for my goods now? And they can't get it right.
I think it's more difficult if you're an actual importer or exporter because that's your business. And there it makes a big difference. From us as investors, I don't think we have anywhere near the stress that people who are running businesses.
But they don't get it right either.
They never get it right.
That's why they have clauses, I guess, with, whatever our landed price is, we'll give it to you plus 5% or something. Yeah. So if the rand moves too far, then we're going to change the price we give you.
Well, we've run out of time, but I mentioned previously the story about Mota Wakel, who was the first woman from Morocco to win a gold medal at the Olympics for the 400-meter hurdle. When asked to explain her success, she described the 400-meter hurdle as the closest synergy to life. To quote her, "It's the longest hurdle race in the Olympics. There was a start and a finish, and between that, you must get over all the hurdles." What message did I take from this? I think investors forget that investing is like a marathon and not a sprint. David, Craig, thank you for joining me this evening. It's important to note that our program tonight is to provide information and should not be construed as advice. Next week's program, we'll be dealing with short-term insurance, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.